Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of information looking backwards at history. We're going to look at the population growth on an annual percent change because that's kind of what hits the market with a larger population. And I'll show you kind of how that works its way through. We'll look at inflation, interest rates, and then tie all that stuff that we've learned from history and try to tie it to today and see where we are in those types of market conditions. And you guys can make up your own decision on what's going to kind of happen ahead of us and what's going to go on potentially for what would be a good investment. So here we go. This is my opinions here. I've got the good old PowerPoint back to basically coordinate all these slides. So this is the annual percent change in U.S. population from 1900 to 2021. It is of my opinion that the demographic and the way that the demographic interacts in the economy actually sets the pricing of assets. And one thing that impacts the pricing of assets is basically interest rates. And interest rates more or less just follow whatever inflation there is in the system. The inflation comes from the demographic coming into home buying years. So people that were born in 1920, and remember, it's when they buy homes. It's not when we buy homes today. It's when their age group would have bought their homes. So if you're born in 1920, add about 25 years, 20 years, something like that, because they would buy homes when they're in their early 20s versus today, which might be more towards the average age of a first-time home buyer might be 34, 35 years old. So it's a little bit different. We have to add that in. So we're looking at the demographic, the population coming into home buying years. We have to add that to their birth date, their when they were born, add that in. So if you were to look, if this was 20 or 25 years, this demographic, this very big change, think of it as a wall of population looking to buy homes all at the same time. This would have hit in 1940 to 45. We should see a large increase in housing starts. The baby boomers, which were born a little bit before 1940, all the way up to about 1950, add about 30 years. So that's 1970 to 1980. That would have been the bulk of the buyers, and you can see there was a large increase and even a pullback in that demographic. We could see the 2000s bull market. We had a little bit of a surge higher, not a huge one, but it is there. And then we've got what's coming up now. If you add 30 to 35 years, that's 2020 all the way out to about, if you add 35 years to that, let's say that's about 93. So 2027, I would say. So this is between 2020 and 2027, depending on what age you use for a first-time home buyer. And the average age is 34 right now. So this is what I think drives the inflation. This is inflationary in the 1940s. This is inflationary in the 70s. This was inflationary in the 2000s bull market. This is inflationary of what we're in today. Now, today there is some anomalies with stimulus money being sent out, which I do think has an impact on what's happening today. And I'll describe kind of what's going on with that and show you what potentially is happening. But we first need to understand these other cycles and the drivers of it, and then we can compare where we are today. So if you remember, basically 1940 to 45 is where this group would start buying. This one's 1970-ish all the way to 1980-ish. This one here's that little bull market there, and then we've got one that's coming up right now that we're in the middle of. So if we were to look at the long-term annual U.S. housing starts from 1890 to 2015, we can see some things here. We can see that large demographic from 1940 That's this demographic right here. If you add 20 to 25 years, that puts you in this general vicinity right here. And you can see the big the big response to the home builds that came from that demographic. This big move is this big move. You can see this thing crashed here before the 1940s. There's that crash there, and then boom. We had a much higher amount of homes being built, and that is inflationary. That's inflationary because what you're doing is you're increasing the credit in the system. People are getting loans against those new homes that are being built. And if you're building ever more new homes, you're getting ever more new loans, which is inflationary. Now, I don't think we've seen an inflationary period without housing starts. So housing starts being elevated, I should say. So here we had an entirely new level of housing starts. It would be, if I were to make a guess, it would be highly inflationary in the 1940s and 50s, all the way up. We had 1970 that even had a higher propensity of housing starts, all the way out to about 1980s out here. That's where we would have had a large inflationary push. You can apply this to any country. If their demographics getting larger and larger, they're going to be in an inflationary type of environment as credit outpaces the goods and services. We can also see that we had a massive bull market in the 1920s, and then the bust of the housing starts and the housing market. This was a bust and a deleveraging type movement. So on the back sides of these, there could be busts of deleveraging. And that's huge. This was a massive deleveraging process here on the backside of the 2000s with all those bad loans. They also made very dicey bad loans in the 1920s. And the banks got into a very bad problem with all those bad loans. There was a massive deleveraging in the system. That was the depression. It came from the housing market basically crashing. So if you were to look at inflation rates, I'm proposing is you're going to see higher inflation rates in the 1920s, higher inflation rates here in the 1940s and 50s, because we are at an entirely new level up here. So if you look at the inflation rate and you look at that, you had inflation rate in the 1920s here, not too bad. It wasn't a huge big run up compared to what the average was. We just went a little bit above the average there. This was a massive run up in the 1940s and 50s. So what you're going to see is in the 1940s, you're going to see large inflation. Large inflation here in the 1940s, even 1950. It came on back. It came on back here and paused a little bit. Remember, inflation is, if you have a rate here, you're going to come up above that rate. And then in the 70s, we also had a much larger inflationary period with these guys over here at a higher rate of annual U.S. housing starts. That's your inflation rates. You had a couple of waves here. You had a couple of waves here as well. There's like these three waves. 30s, 40, and 50. There's the wave. Here's the long-term interest rates back to 1790. If you look at this inflation rate in the 30s and 40s all the way out, you saw an inflation rate that bottomed in the 40s and really started to take off. Inflation and interest rates are tied together. Inflation comes first, interest rates chase later. Here's one in the 1900 to 1920. We could probably look 1900 to 1920s. There's your higher elevated housing starts in the waves. There's the 1910s, big inflation in the 1910s. And what we're looking for is an new elevated level of home buyers and a demographic coming into the 1910s. That's off the chart. It'd be this elevated demographic up here. You have to add 20 years, and it's off the chart to see the demographic of this home buyers coming in the 1905 period, because that would have been the late 1800s. But it was elevated at this time here. That's what this elevation is here. It dropped down, and then we came back up. It's all demographic driven. And that's what the inflation's driven by demographics. The interest rates are driven by the demographics. Between 1981 and on, you can see that the inflation rate was lower. That's 1981 and on, lower inflation rate. And then if you look at the demographic from 1980, add 30 years, 1980, your demographic was lower all the way till today. This was a decline in the demographic, decline in inflation, decline in interest rates. Interest rates just chase inflation. And the demographic's the one that's setting it, in my opinion. So if we look today and we transfer to today, and we look at the December 1st numbers, we're at 751,000 housing inventory. If you were to convert that into months, it's a little bit over 2 months of inventory. We are at a very low level of inventory. And the way that this cycle works is we come from an inventory level, and we draw down that inventory level, which we're doing. We're drawing it down here, and I'll show you a longer term chart. This is from 2017 onward. We're drawing it down to basically nothing. This is what kicks on the housing starts. So the demographic right here, this increase in demographic of the millennials is what's driving that housing market inventory down. It's going to kick on the housing starts, which is going to kick the housing starts up. And then the housing starts and the loans against the housing starts is what's going to kick up the inflation. And that is what is organically driving it. That's what structurally drives the markets. Because I'm going to show you what I think is causing havoc in the middle of this cycle. So we're still at very low levels. At 2 months of inventory, that's roughly where we're at. We are lower than all the way back to 1964. We have lower inventory levels than any time in history, going back to 1964. And that is today, with where we are right now. It's not where we were at the bottom of 2022 or in 2021. It's where we are today at December 1st, 2022. And the latest data we have, we are down here. We are below every single point going back to 1964. Our existing inventory is lower than everything. You can see that we had a massive problem in months of inventory on each of these cycles. The 1972 to 73 to 74, we went to 10 months of inventory. This here is a hypersupply phase in our real estate cycle. You're going to have a recession when you hit this. That means that the demand can't absorb the homes that are being built. So we had a recession in the housing market. It pulled back. Then we had the other wave. Here's your demographic. Your demographic came in and bought all those homes. There's your pullback. And then we had another demographic come into home buying years. That's your pullback, in my opinion. It's in the demographic, the pullback between the demographic. So they overbuilt, came back, we overbuilt again, and we had another recession. These are the waves. The waves came from the demographic. Wave 1, wave 2, wave 3. Inflation didn't come in 3 waves. The demographic came in 3 waves. The demographic is what drove it, in my opinion, to some extent. It has to. It has to. It's got to be a larger population demanding more things and putting more credit into the system. And the majority of credit is created from loans in residential real estate. That's where the majority of credit is created. And if the majority of credit is created in residential real estate, you're going to have a demographic which is larger, building more homes and making more loans and spending more money because they're in that time or they're in that period of life. So the key takeaway is we're at 2 months of inventory, which is below the entire curve here. We cannot be in a hypersupply phase with no supply. That is incongruent. And historically, we've always had recessions after coming up with these large months of supply. So if we look at this is monthly supply of new houses in the United States. You can see that we've always had these high monthly supply of new houses. And basically, that's tied with high monthly supply of houses and high number of months of existing remaining inventory. So we've had high months pullback, high months, pullback. You can see the dark recessions. They're tied to the housing market. High inventory here in 1970, recession. High inventory in 1974, there's your recession in 74, 75. High months of inventory in 1980. 1980, we were off the charts in inventory. It's being driven by the demographic and how the real estate market interacts with that demographic. And you can see all of these recessions. 1990, just after 1990, look, high inventory of homes. 1990, boom, there's that decline, or the increase, and then the recession afterwards. We had a massive increase pump all the way to 2008, and there's your recession. The demographic and the housing market and the loans coming into the system is what's causing these recessions. Now, if you look on the right-hand side, we have a large amount of monthly supply of new houses in the United States, and they're not in our existing inventory. Our inventory is super low at just over 2 months. So the new homes aren't in inventory, they're in production. The reason this was ramping up is because we had no homes to buy in existing inventory. So people would go and they'd go order new homes, and this is the basic backlog of all the homes that we're building in the system. This here, by definition, is an expansionary phase of real estate. We were going into a very large expansionary phase, and we still are in an expansionary phase of real estate. What's incongruent here, based off of history, is when we have high monthly home of new houses, high monthly new house supply, we also had a number of high months of existing inventory. What's different here, and which is an anomaly in history, is we have existing inventory at 2-point-something months, which is off the scale to the downside. And we have high monthly supply of homes. They're not finished, they're not in inventory, but they're in progress. So basically what happened, if we look at today's data, is we've got a bunch of people buying new homes, and the interest rates went up so fast that people are pulling back from buying those new homes, from going through, because of the affordability. Now, why would interest rates, if interest rates here more or less just chase the inflation rate, how can you be in a certain area where you have low months of inventory of existing homes and have interest rates go to a level that's not sustaining the housing market? How is that possible? How come we never had that type of scenario in history before? We've always had, whenever we had high months of supply of new houses, we also had high months of remaining inventory and existing inventory. How is it possible that we have this large disconnect today with high months of basically inventory in the building process and no existing inventory of today's housing market? How is that possible? The only way that I can think that this is possible is that the stimulus money came into the system in copious amounts. Now here's housing prices, just to show you guys. Here's housing prices. I'll show you guys real quick. These are real housing prices. This is your annual private housing starts. It's just declining here. So this is the stimulus money for the M2 money stock. This is what's causing the problem. We had this gigantic vertical growth of stimulus money that just came flooding into the market. This stimulus money, which is inflationary because it was sent into the hands of people, is pulling interest rates up to a level that the housing market cannot sustain. And I don't think we've seen this in history before. So this here is the root cause, in my opinion, of where the interest rate, because of the inflation from the stimulus money, it pulled that interest rate too high for the housing market to be sustained at the interest rate we are today. So the monthly supply of new homes is that high because we were in an expansionary phase of real estate. Everybody put orders in because there's no inventory of the existing inventory. And the reason we're still this low and everything is basically stuck is because of the interest rates at a level that the stimulus money created. So what I think is going to happen is that the people still need those homes. The demographic still needs the homes here. They still need these homes, and the interest rates are putting everything on pause. When the stimulus money works its way through the system, I think that the interest rates will go down to some degree. It will be disinflationary until the housing market can kick back on. Then we will be at the inflation rate of whatever the housing market can sustain. And then interest rates will also be at a sustaining level for whatever the housing market can sustain. That is my opinion. So as you come through here, this is your total bank credit divided by GDP. And your total bank credit comes from the loans in the housing market. And you can see on the right-hand side, we had this massive boost. We were coming into an expansionary phase of real estate already, and we had this massive boost at the beginning of it from stimulus money. That was back in 2019, 2020. We've come on back from that, and we've basically done a return move, and now we're going to, I think, head higher again at some point when the housing market kicks back on, whenever that is. Back in July of 1998, we broke out of this total bank credit to GDP, and that's when we basically went into a large commodity boom. What this is telling us is that bank credit is growing at a faster pace than your goods and services. That is inflation. And inflation causes a rotation of money in the system where money rotates from stocks and bonds into commodities and precious metals. And you can see that that ended in 2008. They did some stimulus money, which also kind of pushed us up one last move in 2008 to a 2011 peak. Without the stimulus money, that would have been the end of the move, in my opinion, in 2008. But that's what I've seen here for total bank credit versus GDP, which is inflationary. Now, if you look at that, we had a buy signal in 1999, which aligns with 1999's right here. It's right here on your bank credit going up. That would have been your buy point for commodity stock ratio. We had a sell point in 2008, which is also the sell point here for total bank credit to GDP, where it stopped and started to head back down. Now, this here is a stimulus money that we just got, and I think it's going to throw false signals in the system. It's going to make things a lot more messy and a lot more difficult, and it's going to fool a lot of people, I think. Because what it's doing is it dragged interest rates up, it dragged all that up. And usually what drives it is the housing market. The inflation comes from the housing market. It comes from this demographic here coming into home buying years. It comes from the annual housing starts and the demographic and the housing market interacting with each other when that demographic turns into home buying years. And that's where the inflation and all that other stuff comes. That is the organic, way of doing it. So when everybody looks at all of these previous, peaks here, what they are doing is they're looking at the peak of the demographic coming into buying years, and they're saying, well, this is going to be a pullback. We're going to have a recession and a potential pullback and all that stuff. And the recession is coming from your inventory and your housing starts dropping. It's from the new houses being built from the housing starts. Where is it? Where's the red line? It's from the housing starts dropping. That's your recessions and your deleveraging in the system. It's all these drops. What's happening today is we're stuck in the middle of an expansionary phase of housing, and the stimulus money is creating the signal. The stimulus money is creating this signal that yanked the interest rates higher, which is eventually going to roll over. That, in my opinion, is creating a false signal, this money right here. It's not because we're going to get a deleveraging in the housing market necessarily, because we have no inventory of existing homes. We have a lot of new homes in the build process, but we need interest rates to come back down. So I think we're going to get a hangover from the stimulus money, a hangover where we could pull back a little bit. Things will slow down. And then the interest rates are going to have to go back down to a sustainable level. Now, if Powell hits the gas on the stimulus money again to re-kickstart everything, that's going to be a huge mistake because all of those people are still in the home buying years. And if interest rates go down to an affordable level and he kickstarts with stimulus money, it's going to go right back into the system. And I think that's what we've got here is a setup where we could go higher in our total bank credit to GDP once the interest rates go lower. Here's the commodity to S&P 500 ratio. You can see it would have been a good buy time in 99, 70, 71, and 2020. That puts you it'd be at the bottom here. You can't really tell there, but that puts you, let me go forward here. That puts you here. So this is the 70, beginning of the bull market of commodities, the end of the bull market of commodities. And you can see that we were in an expansionary phase of real estate for the majority of that time. This is the expansion phase of real estate. You go back to the other one, the last one was 98 all the way till 2007 was the end. And sometimes it goes a little bit past that as it goes below it. This was another expansionary phase of real estate. And you can see that we have a lead-in pattern that went basically the same as we had here. So I think we're going to go higher here up into the housing starts. But right now we are calming back down because of the stimulus money and the interest rates that the stimulus money has grabbed back up. So again, commodity bull markets, this bull market here to here, here to here, and here of what's coming all happened under expansionary phases of real estate. And we're in an expansion phase of real estate that kicked off in 2020. And we've come on back because I think the stimulus money pulled interest rates to an unsustainable level. And here is the commodity continuous index. This is a double bottom. You can see the lead-in pattern, bottom one, bottom two. And we're going to come back up in a large, I think, commodity bull market in relationship to other things like stocks. So it's not that we just have, I'll say this, it's not that we just have the demographic coming. We have all the charts too that are putting in double bottoms of gigantic patterns in everything, in copper, in nickel, in oil. You can go on and on and on, in all these different commodities. It's happening in all the ratios. If you take gold to stock ratio, gold to money supply ratio, you look at the CRB index in relationship to the S&P 500, we're putting in double bottoms everywhere. So we have the alignment. Now, what makes this difficult is the stimulus money came into the system, and I think it's throwing false signals. Because if it was a positive signal that we were for surely going into this big housing crash where we're going to have a large deleveraging, we would see the existing inventory up at 10 or 12 months of inventory, and you'd see new home inventories higher. All we see is new inventory levels are low. We have a bunch that are in progress of being built, and we've got existing inventory at 2 months, which is lower than any time else in history. What gives? Right? What gives? The only thing I can explain is that stimulus money came into the system, created an inflation from that stimulus money, went up to a level that yanked interest rates up with it, and now we're at an unsustainable affordability rate with interest rates given the stimulus money pulling it up that high. We've never seen this in history before where we had interest rates slow the housing market. It's always been the housing market pacing the interest rate. But this time around, the housing market didn't pace the interest rate. It was the stimulus money that did, which makes it a lot more difficult because you've got an external pump into the system, which is impacting our leading indicators. So what people are going to do is we're going to get an inverted yield curve, just like it inverted in all those other times, like we saw in the housing market. The housing market is what inverts it. The inflation coming from the housing market inverts those yield curves. The inverted yield curve gives you a signal of what market condition we're in. But the question is, with an inverted yield curve from a fictitious pump of money into the system, which is not structurally being driven by the demographic, how is that going to impact the signals that people are seeing And how is it going to impact the expansionary phase of real estate? We don't know that. We've never seen this before. That is what you're up against. So in my opinion, I think when interest rates go down to a certain level, it's going to kick the housing market back on, because the demographic's still there and we never went into a hyper supply phase. We just dipped on the entire back end of this expansionary bull market in real estate. And I don't think you can do that, because if you're still short homes, you're still short homes. And I know people, they try to argue, oh, there's people who own 2 homes. Well, guys, they're not on the market to be sold. So I don't know what you can do there. So that's the setup, guys. That's the setup. That's where I think we're at right now. I'm going to remain long, and we could get in a pretty bumpy ride with the stimulus hangover money coming off and whatever is coming next, which is deficits in commodities, and we got to kick back on the housing market in that expansionary phase of real estate. The average length of the expansionary phase of real estate is 4 to 7 years. You usually see double-digit appreciation in housing during those years. With the stimulus money coming in, it blew everything up because they did QE. They held rates low at the same time that we were in an expansionary phase of real estate where everybody wanted to buy a house. That was jet fuel, for this move up. And now we still have a bunch of buyers, but they all are saying it's unaffordable with the interest rates and the prices where they're at, because prices are sticky. So I think what's going to happen, it's my guess, and it may or may not happen, is that interest rates may come back a little bit. Mortgage rates should come back at some point, hopefully, and it'll kick the housing market back on. And once that kicks back on, we'll get more inflationary pressures. So Powell, I don't know how he's going to stop that. He can hold the rates high, but then he's going to get pressure from the debt that rolls over. And if it rolls over, it's going to cost a lot more in interest payments, which is inflationary because they're going to have to print money. He's in a really bad position. If you hold rates high to hold the housing market down, he's going to have to pay more for it in terms of debt rollover. So it's an interesting dynamic there. Everything looks good from a perspective of the commodity side in terms of charting. So I'm going to remain long. There's no point in trying to time the short-term stuff. I'm going to remain long. Just ride it. I'll buy on pullbacks because I think we're in a bull market, and I'll buy the pullbacks. All right, guys, that's what I've got for today. Thumb up for the content. If you guys want to sign up, the Platinum membership, finding-value.com. Use the word discount in the coupon code to get a discount for the Platinum members. Also, we have a training session Thursday, which is tomorrow, or today, I should say, because this is going to be released Thursday. It's today at 5 p.m. Mountain Standard Time if you're a member, a Platinum member. It's just going to be a technical analysis question and answer session where you guys can ask me anything about technical analysis. It'll be back and forth. I've already done a couple of these sessions. I've taped it. They're on the website, and you can watch the other ones with fractal analysis and also more classical stuff that I look for in technical analysis. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.